Hold on to your butts.
Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. That quote from Jurassic Park from Samuel L. Jackson, hold on to your butts, was a very fitting statement I said on the weekend. Unbelievable wild action on the week. On Sunday night on the futures, and of course this morning, ES futures were down 250 points at the lows. NASDAQ futures, NQ down 1,200 points. The Nikkei, you know, was halted, down like 10% today, 20% the last couple days as the carry trade unwinds. Unbelievable action. Our systems have done extremely well. The mean reversion systems, they're bidding cash. They exited last week for nice profits. And our KISS systems have done their job on the indexes. On the S&P and Qs, they signaled you to get out back on July 18th and 19th. Here's the Qs. S&P is similar. It's, I think, one day later. But that helped you avoid, a good 60% of this downside. That's the importance of having an exit plan, guys, versus just buying and holding and not having any exit plan. So, again, awesome job by the systems. And if you're not a member of Breakpoint Trades, consider subscribing. Go to the enroll button and, sign up now. Our best membership is a 6-month membership. You get roughly a 50% off of membership over the monthly. All right, enough of that. Get back to this video at hand. Again, I just did the extensive weekend newsletter on Sunday, so this is just a follow-up. This is our back-end recorder for our website subscription service. Let me get that started now. Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. This is the Monday, August 5th newsletter. Tonight's newsletter, as you can see, divided into 6 major sections. Same general theme as we always keep. First, have the opening statement, talk about some of the systems which have knocked it out of the park lately. We'll move into the general market analysis, various indicators, a few market sectors, US dollar, Bitcoin, crypto, commodities, precious metals, GDX. And as far as trade ideas, nope, not in this volatility, guys. In this kind of market, cash is king. Cash is a position. And if you're going to trade some stuff, it's best to focus on, one or two items. If you have a bunch of things to watch, you're going to underperform. Anyway, wow, what a market. Again, unless you were hiding under a rock, you saw the headlines last night about the major stock market crashes around the world, particularly in Japan. Nikkei is down 20% in 2 days. The S&P 500 and triple Qs topped out on June 16th in 2023. They topped out in June 27th, so 10 days later. That's pretty damn close from a seasonality perspective. All right. Again, it's been a hell of a sell-off the last 3 weeks. ES futures hit a low of 51.19 overnight. ES futures were down 254 points at the lows before recovering. That is a amazing move. We haven't seen a move like that, guys, in years. NASDAQ futures were off 1,210 points. Dow futures were down 340 points at the lows. By the way, today was a 92% down day, and that's actually a positive. A lot of times you might need a couple of those days, and it's also good to have a 90% up day. That said, as far as the market, what I think here, and I had some text here, I don't see it, but the way I view this is still wave 3 down. And so, therefore, assuming we put in some sort of short-term trade low today, I see this as a wave 4 bounce. Ultimately, it should fail, and we come back down to a 5. And that'll be the better bottom. There's no positive divergence on 30-minute, 60-minute, 2-hour charts. That's more indicative of wave 3 action, not wave 5 action. A couple other things. Bitcoin had a major crash on the weekend. Obviously, it came off the lows too. Hit a low of 49,203 before bouncing kind of from a demand zone. And guys, Bitcoin is not a safe haven. Okay, keep saying that. It's speculative investment, and it sort of mirrors the triple Qs. Rest in peace, carry trade. Talked about that on the weekend, where institutions and big players that go to Japan borrow rates at near zero, then come back here and invest it in the U.S. Well, that has been unwinding. We've been seeing that, especially with the big rally in the Japanese yen. Remember, I've been all over that. I was very bullish on the yen a month ago. put that out as a long idea. Hopefully some of you bought that because it's been a very nice trade. Again, KISS systems have done their job extremely well. On the S&P and triple Qs, on the website, the KISS systems got out on July 18th and 19th. So again, they didn't catch the top. They're never going to, but they did a damn good job about keeping you out of this mess. Mean reversion systems also killed it by exiting last week. That oversold bounce into Wednesday and Thursday. They made money like a boss. They did not go back long today as I thought maybe they would on the weekend. But that said, should we, the next wave lower when we get it, maybe we'll see some of the mean reversion systems go long. I think those would be good trades. All right. And again, in this type of market, most assets get sold off in order to raise cash, right? While gold has been holding up, it did reverse today. I wouldn't be surprised to see that little rug pull there. But let's go ahead and jump into things, guys. And I'm just going to cover a lot of charts I did last night. Again, no new trade ideas, nothing new. We're just going to go over things and show you what transpired. But first off, talking about the systems here. Here's the SPY KISS system right from the website KISS system tables. We had it to mark 13 at the highs in mid-July. And the KISS system got out, what is this? 1, 2, 3 days off the highs. That's pretty damn impressive. So, it kept you. Sorry about that, guys. I had to refresh the chart here. Didn't include today's candle. So again, here's the SPY KISS right from the website, the KISS trend system. Like I said, the KISS systems are designed to keep you in a bull market uptrend, but give you that protection with the smart trailing stops so that you don't have to go through these big market crashes or bear markets. And this didn't get out at the highs. It's never going to, right? But it got out about 3 days off the highs. That's pretty damn impressive on July 18th, July 19th there, or 18th. And so you avoided a good 60% of this sell-off or more. So great example of the KISS systems keeping you protected versus, the buy and holders who are still in this and have ridden this all down. Next. Image number 3, here's the triple Qs right from the KISS tables on the website. You can see the nice exit there. This was on July 18th. I think the SPY was July 19th. About 4 days off the highs. But excellent exit there. Allowed you to avoid this last market carnage the last couple weeks. All right. Again, beautiful example of the KISS systems doing their job. Next. Talking about the mean reversion systems, I discussed these on the weekend. Again, one thing I was looking for, I thought one of these mean reversion systems might kick in a new long trade, particularly the QEBTS. It ended up not taking a trade today. I saw that conditions were triggering last night, but as ES futures continued lower, then it went away. What happened is price went too far below a moving average that it uses for a filter, and the system is not active. That said, like I said in my opening comments, the market may have some sort of oversold bounce here now, but I think it'll form a lower high, maybe a wave 4, fail again and come back down. Then maybe we'll see some of these mean reversion systems take a couple long entries. And again, I will let you know via trade notification if that happens. And if you're just on YouTube, again, consider subscribing to us so you can get trade notifications to these awesome systems. Mean reversion systems also knocked it out of the park, as I stated. They were long. They bought like a middle into that downtrend, and then they exited last week on Wednesday and Thursday morning, basically right at the highs, made money. They had a surgical exit basically, and locked in those gains, and then the market sold off. Just excellent. Next. Now, as far as the general market here, image number 15 below, here's a 15-minute chart of ES futures. And several of us were talking about this today on our trading community. So you had your initial big rally, 130-point rally off the morning lows, and that was a short-term symmetry break. So I was looking for a higher low. You have sort of an inverse head and shoulder pattern here. You can see the bounce late in the afternoon. So we'll see if this can follow through a little bit tomorrow. Again, it's going to be wild action, guys. Japanese market opens at 8 p.m. Eastern, and that could also cause some action as well in our futures. Next, let's go and move back to the general market. So item number 6 shows the index sector table, what transpired today with the markets. And boy, bloody red everywhere. Look at these indexes. Again, despite bouncing off the lows, you know, S&P down 3%, NASDAQ down 3.5%. Those are big moves for a week, and that was today. Out of the market sectors, there's 21 of them we follow. Every single one was to the downside. Even some of these defensive sectors like utilities and healthcare and drugs. All right. In this type of market, everything tends to get sold to raise cash. So this was a 92% down day. So bloody down day. Everything down. Currencies, US dollar down 0.5%. Crypto, Bitcoin down big. It was off the lows too, but man, that has been selling off very strongly. Not a safe haven, guys. It did bounce off of a support area right around the upper 49,000 area. I'll cover that later. Commodities weren't too bad here. The index DBC was only down 0.25%. It bounced off a support area. Crude oil down 0.8%. Natural gas continues to be weak. Copper continues to be weak, indicative of a slowing economy. 2.5% down. Uranium down another 2.5%. But DBA agriculture bounced off its 200-day moving average of 1%. Corn bounced about 1%. By the way, corn has a nice daily trade. I think it's a low-risk trade. I'll talk about that later when we get to that section. Precious metals all down. Gold down 1%. It was up initially in the morning, but like I said, in this type of market, everything ends up being sold just to raise some assets, and that was end up happening there. Silver down over 4%. GDX, the miners, down 3.2%. They've been underperforming, so that area looks like it needs more correction. I wouldn't be surprised if it pulls gold down eventually. As far as the bond market, still a small pullback in the 10-year, 30-year Treasury yields, but they were off their morning lows. Next, item number 7 shows the economic news calendar. We had ISM today and, PMI. That, folks really weren't focusing on that. Not a lot of news items this week, as you can see. All right. And the other things you got to be aware of is potential geopolitical, such as the Middle East, if Iran were to attack Israel, stuff like that. Then you have the issues with Japan and just all kinds of stuff, guys. Basically, when it rains, it pours. Next. First chart below, item number 8, here's the Japanese or the Nikkei index. And look at this sell-off today. Down 12.4% in a day. Is that down 20% in just a few days? I mean, honestly, this looks like the 1987 crash for the U.S. markets. Just unbelievable. So the carry trade's being unwound here. We all knew this was a house of cards, and it is being unwound. Next, image number 9. So here is with the move in the Nikkei, what we're seeing, the move in the Japanese yen, we're seeing an unwind of the carry trade. And the carry trade, again, that's where the big institutions, etc., can go to Japan, borrow at very low rates, near zero, then come back and invest in our markets. That carry trade starting to be unwound, and the carry trade directly benefits the NASDAQ in particular. You can see how the Japanese yen was going down. The NASDAQ was going up, so there was an inverse correlation here. So look at that recent big rally in FXY, Japanese yen, completely mirrors on the opposite, the sell-off in the NASDAQ. Next, chart number 10, here's the Japanese yen ETF itself. Remember, I became bullish on this just over a month ago. I said I was going long. I said it looked like a low-risk long bottoming play. Hopefully some of you followed me on this trade because it's been an excellent trade from those lows. Broke out that first downtrend line a few weeks back. Last week it took out another downtrend line, and today it gapped up following through, though off those highs. Finally, chart number 11, here's the monthly chart. Again, remember I've been showing this monthly falling wedge for a while, and you can see so far playing out, broke out of that wedge. Up nicely this month. Chart number 12, here's Bitcoin. Now this is the weekly chart. You can see it was off the lows today, but heck of a sell-off. Here I redrew this expanded pattern. You can see it did bounce off a little support area here. The bigger support is down here in this weekly demand zone. which I think would be a better buy, but we'll see. We do have a little RSI divergence at the moment on the weekly. Chart number 13, here's the daily. So you can see the meltdown and then kind of bounce off the lows today. All right, before we get to the major indexes, US indexes, so let's talk about some of these. Let's just follow up on these large cap tech stocks. I'll show you how these ended up. Remember, these have been selling off for weeks now, kind of leading the market down. Here's Nvidia. It filled that open gap finally. That was at least a magnet, and it got into this little bitty demand zone here. You also have the 200-day moving average down there. That could have been a little area to dip your toe. Again, you could have really, anything you would have bought this morning did come off of its lows, at least for a trade bounce. A valid trigger to the upside, if you want to see strength, would be breaking this downtrend line on the RSI. Those can give you very good trades. Next, chart number 15, here's Microsoft. Remember, this has also been selling off as well. Big gap down today, so it's firmly below its 200-day moving average. Chart number 16, here's AMD. You can see AMD has been melting down after it stalled at that supply zone back in mid-July. That's similar where the market topped. Anyway, it came down. You can see today it bounced off the top of this demand zone. Could have been an area to dip your toe in, but again, realize it's not for everyone, guys, in this very fluid market. Again, like I said, what I think the general market's going to do, I think it's see a bounce here. But I do think it may need to come down again, so I'd be careful buying a bunch of swings at the moment unless you're just willing to give them enough room. Chart number 17, here's Meta. Now, this is one of the big cap tech stocks that's been holding up the best. It too obviously got hit today, down 2.5%. And again, that's off the lows. It was down about 5% at the lows. But this one's been holding up the best. Chart number 18, here's Apple Crapple. Remember the news story on the weekend, Warren Buffett, Berkshire, they're reducing their Apple position by at least 50%. And I talked about this on the weekend, that Apple had sort of a slanted head and shoulder look. And you can see that actually played out. The measured move of this head and shoulder was essentially met today. You can see it got into this little demand zone before bouncing. Chart number 19, here's Amazon. Also a nice gap down. Again, it's been selling off since early July after forming a lower high. Sold off hard last week. You can see today it got into this lower demand zone. It's also below its 200-day moving average. Chart number 20, here's Tesla. It also fell into this little demand zone down here today before bouncing some. So there you go, what some of these big cap tech stocks look like, guys. Let's move on to the indexes. Chart number 21, here's the Dow. Again, big sell-off here recently. Now it's down to another little demand zone down here, or potential support, and the 200-day moving average. Definitely a big unwind. Chart number 22, here's the weekly chart. I'm wondering if the Dow needs to retest this area. That's previous resistance, now support down here around 37,000. Moving on to the S&P 500, here's the weekly. I'm showing this because the S&P got into the upper part of this little demand zone before bouncing today. Okay. So that's something to monitor. Chart number 24, here's the S&P KISS system. Remember, this got out a while back. The website version got out before this one. This is the custom version I typically show in the newsletters. But the website, one from the website KISS tables actually got out at a much better price. Got out back here on July 19th. Quite a bit better, but still, doing its job. You can see it's below the weekly ATR now. 200-day moving average is below there. Chart number 25, here's those 4 time frames. Really not a lot to say here, guys. Again, ATR is your main resistance on a bounce. Moving average ribbons, like I said, got pretty wide down here, so that's why I wouldn't be surprised that we have some sort of fourth wave bounce here. Next, chart number 26, here's the 2-hour chart of the SPY that I showed. Apologize for that, guys. Trade station.
Order filled. Order filled.
If you were wondering what all that noise was, I had some trades pop off on my trade station, some automated systems. Anyway, here's the 2-hour chart of the SPY showed on the weekend. So clearly today's move is definitely still wave 3, right? Now if we put in a trade low here, I'm viewing this bounce as a wave 4. So if we're in the wave 4, I don't think it's done yet. I think it works higher. You can see we have this open gap up here. But ultimately, Once this bounce is done, it should fail and then come down again. Okay, there's no MACD divergence on any of these time frames. That is indicative of a wave 3, not a wave 5 completed move. Next, chart number 27, here's a clean half-day chart, just showing some of these gaps and various levels. So realize there's an open gap down here at 50.73 that was never filled. So one option is if we bounce here in a wave 4, then stall out up here somewhere, then come down again in a 5, maybe we fill that gap and that'll be the bottom. That's an option to consider. Chart number 28, here's another chart I showed on the weekend, this half-day chart with these various counts. Again, clearly today's action is still wave 3 at the lows. If we get a continued bounce here, some sort of wave 4, maybe up to one of these fib levels before stalling out. Chart number 29, here's the daily S&P. Again, you can see we gapped right down below that channel line. 200-day moving average isn't very far away now. Chart number 30, here's that leading diagonal, ending diagonal I've been showing that would lead to a deeper correction, and that's been playing out, guys. Chart number 31, here's a 2-hour chart of the SPX. Again, after that 3-wave reflexive bounce last week, that was obviously bearish. Anytime you only have 3 ways up in a downtrend, that is bearish, guys. That is a reflexive move. You can see how the moving average ribbon pinched there just perfectly before we had that flush down. Now we'll see if we got a little trade low today and we can bounce up here a little bit. Like I said, there's no MACD divergence whatsoever. And chart number 32, here's a 15-minute chart. No MACD divergence here either. All right. That said, the move off the lows today was about 132 points. Okay. That is a symmetry break. That's the largest bounce relative to the high on August 1st. So that sets up for a potential higher low, which we may have put here in the afternoon, and maybe like an A move, B move, and then get a C up. And then I think that could complete the 4. Next, chart number 33, here's the triple Q's KISS system. Again, exited like a boss way back there on July 18th, as you can see. Avoiding a lot of this downtrend. You can see the triple Q's went briefly below their 200-day moving average before recovering a little bit. Chart number 34, here's the 4 time frames. Again, just similar look to the S&P. ATR is your main resistance on any good, decent rally now. Chart number 35, here's the weekly that I showed in the weekend. Just showing this because you can see it basically gap down, opening right at that 50-week moving average where it bounced off of. Chart number 36, here's the daily triple Qs. This is the zoomed out version going back to 2022. Been showing this uptrend line from January 2023. And you can see we got damn near close to that today, right? Symmetry has played out beautifully. That first sell-off had a symmetry break. That was the largest pullback in the uptrend. You can see about 48 points. Whenever you have a symmetry break, that generally leads to a lower high, which occurred. Got a lower high, stopping right at that resistance before coming down again. So the thing to watch now would be this lower trend line here, going back to, December 2022, January 2023. Also, I added some fibs from the October lows. Notice we closed right around the 50% fib today, 61.8% fib. If we break that long uptrend line is 402.90. Chart number 37, here's another daily chart of the Qs. You can see we filled that open gap. Remember, that was unfilled on the weekend. Well, we filled that today. These open gaps are always magnets, guys. Even this gap up here that was never filled, that'll probably eventually be filled to the upside, okay? So always monitor where these gaps are. The indexes like to fill them. Chart number 38, here's a 2-hour view. This channel, we gapped right below the channel, and you can see they bounced up today in the morning, stalled at that broken channel line, which became resistance. Notice no MACD divergence here. That was blown out. Moving average ribbon has been a great guide. You can see all the pinches on the bearish configuration have led to great little shorts. Chart number 39, here's a 60-minute view. Here I added some fibs from that 47.55 high. So These are some areas to watch, assuming this is some sort of fourth wave. You can see all these shaded areas show all these open gaps. Okay, so the first open gap could be an initial target, even the one up here. The main long-term resistance, of course, is the downtrend line from the highs. That's a way up there at this point. Moving average ribbon, you can see it was pinching last week on that bounce. That led to a good short opportunity. Moving average ribbon is now quite wide here. No MACD divergence here on the 60-minute, which again tells me that the VIX that this is likely some sort of fourth wave bounce. Trevor 40, here's IWM small caps. Again, remember they stalled last week near the supply zone, and boy, oh boy, they have unwound quickly. Trevor 41, here's the daily chart. Again, gap down right into that previous demand zone near the 200-day moving average. So IWM small caps was a great trade out of this coil, but hopefully you took profits, had a stop, instead of giving it all the way back. That high had nice divergence there on the RSI. Trevor 42, here's the 2-hour view. Again, you get a nice MACD divergence on this time frame. So that was an area to get out of Dodge, and it's melted down since. That does it for the indexes, guys. Let's go ahead and move on. Look at a couple indicators. Trevor 43, here's the VIX. So one positive also on the market, I'd say, is the VIX spiked up to almost 66 today. Think about how long it's been since the VIX has been that high. 2020 maybe? So crazy. It came way off the highs, still way outside its Bollinger Bands. This is now the third time it's been outside its Bollinger Bands. Remember this nice base it was forming? I talked about it in my July 24th comments. You see right here in red. That played out. All right. That said, I think the next time this comes inside the Bollinger Bands, that's going to be an excellent VIX Bollinger Band buy signal. Next. Trevor 44, here's the VIX-VXV ratio I discussed on the weekend. Pretty cool chart. I showed how when it's typically have been spiking up to these levels, led to decent market lows. It was a pretty good indication of market lows. This was up in this area on Friday, but you can see it just blew it out of the park, going way up here to 114. So let's zoom out a little bit and see what it looked like in the past. So chart 45, here's the VIX-VXV ratio going back to 2020. So while it was quite high on Friday, you can see nowhere near as high as it got back there in that 2020 March COVID crash, right? That said, it is pretty elevated up here. It is at least up near the levels of it, all right? Next, chart 46, here's the McClellan oscillators with the indexes, the NAMO, NASDAQ McClellan oscillator, and the NYMO, NYSE McClellan oscillator. Not surprised, both closed below the lower Bollinger Bands. In fact, the NAMO closing below its lower Bollinger Bands for 2 consecutive days. Next, chart 47, here's the S&P with the Hindenburg indicator. Clearly this last Hindenburg in early July has played out, right? Usually the way the Hindenburg works, guys, you can get a lot of false signals, but when you get several signals, usually it's more powerful and clearly having the last laugh this time. Next, moving on to the bond market, chart number 48. Here's TLT 20-year bonds. Remember this beautiful coil broke out last week. Excellent trade. Gapped up today, a little off the highs though. Chart number 49, here's TMF. That's the leveraged way to play TLT, triple leveraged fund. I had this as a coil pattern over a week ago. Hopefully you guys took it. It's been an excellent percentage move from that coil break. I took profits this morning. You can see it pulled back off the highs from the black handle, but it was an excellent move. I'm not sure this is done yet. I think this could flag out and push again, but I took some profits this morning. Made sense. Heck of a trade. Hopefully some of you followed me on that one. Next, chart number 50, here's the 10-year treasury yield. Remember, busting down hard from that coil pattern, now near the 200-week moving average. Chart number 51, here's the daily. Just lately, like I said, over the last week, it essentially cratered. Look at that. It was meandering down, and it just fell through the floor. Chart number 52, here's that weekly chart that I mocked up months ago where I was looking for a pullback like this, these dotted lines. I drew those months ago. And this has played out. In fact, it's almost hit the level that I originally marked. I do believe this will form a higher low here, somewhere in this range, above the 3.25% area. And here's the monthly chart. Again, I think that it'll ultimately form a higher low somewhere in here before rebounding. Moving on to the market sectors, here's XLK, technology sector. Again, gap down, recovery, well below its 200-day moving average. There was an open gap which was filled today, clearly. That said, I added some fibs from the October lows. Notice today's lows got near that 61.8 fibs, so usually you get a reaction bounce there, and so far we have. We do have a little RSI 5 divergence to support a bounce. Chart 55, here's the semiconductors. Gap down, recovered that 200-day moving average after the gap down, and here I added some fibs to monitor. Chart 56, here's the banks. Also have unwound here. You can see coming down to this potential support zone before bouncing, a little hammer doji off the lows. Chart 57, here's KRE, regional banks. Remember, again, everything was down today, guys, but we were bearish on this about 2 weeks ago. We thought it looked quite toppy, and it's had a nice pullback, though it bounced right off the 50-day moving average near this broken trend line. Chart 58, here's KRE on the 2-hour. This was really the way to trigger from here. You also had a beautiful MACD divergence there. Chart 59, here's IYT transports. Remember, they lost support last week. They also came to this demand zone today before bouncing. You could see the last time how they stalled in that supply zone. Chart 60, IYR real estate. Starting to melt down a bit. You definitely have an RSI divergent high. Look toppy. Real estate and home builders have been rallying up for the last couple months, basically anticipating a Fed cut. Now they're pulling back with the market. I think this pulls back more, guys, especially if it loses 20-day moving average. Chart 61, utilities. Again, it's been a strong sector, but in a day like today, everything gets taken to the woodshed, and this pulled back quite strongly. Chart 62, healthcare, also pulling back here from the upper portion of that channel. Chart 63, XLE Energy. Remember, this had a reflexive 3-wave bounce a few weeks back. That wasn't bullish, and then we drew a coil pattern, sold off, broke that. Here's a couple potential support areas. We're getting into that area now a little bit. Chart 64, XOP, S&P oil and gas exploration. Just cratered, lost that support last week, and cratering down. That said, guys, I am going to monitor the energy sector here because it is now getting a bit oversold. Here's the bullish percent energy index, BPNR. This thing has now fallen to 22.73. Remember, bullish percent charts go from 0 to 100%. When it's up here is where you want to take profits in this overbought zone. You can see that sell signal back here was actually a pretty good signal. And a lot of the trades down here have been good signals, but it's quite oversold. Again, this could go to much lower. It can go to 0% theoretically, but it's nice to see this unwound, so I'll keep an eye on this sector. Next, chart 66, here's FXI. That's the Chinese market, finally coming into this little demand support zone, right around the 200-day moving average. Chart 67, yen, that's the triple leverage ETF, same deal, it's kind of around that area. Next, moving on to commodities, chart 67, DBC, down 0.25% today. It is below this lower coil trend line now. Got right near that 200-week moving average. Again, commodities have been really selling off for the last month and a half, indicative of some global weakness. Chart 69, here's the daily. Now, why did it bounce off the lows today? Well, pretty much everything did, but you can see bounced right off that December support area. You also have some RSI divergence here to support a potential bounce, and quite wide moving average ribbons. Chart 70, here's crude oil, down about 0.8% today. Been, remember, leaking oil from this broken coil now. Chart 71, here's the weekly chart, just showing that coil zoomed out. Driver 72, UNG, down today, but I'm still monitoring this wedge here, guys. Again, natural gas, one of the toughest things to trade. We had a great trade out of this wedge back in April, rallied up to the 200-day moving average, where was the place to take profits. But I am monitoring this wedge here in MACD divergence, but you need to trigger. Be careful on this thing. But I am watching for potential trade low. Driver 73, copper, continues to melt down another 2.5% today. Again, indicative of global economic slowdowns, particularly in China. So here's an uptrend line from October lows, getting pretty close to that. There is a little RSI divergence now, pretty wide moving average ribbon. Definitely a hell of a haircut since those May highs when the moving average ribbon got too wide. Driver 74, DBA, agriculture, gap down, bounced off that 200-day moving average. Driver 75, DBA on the weekly, bouncing right off this 50-week moving average. This doesn't look too bad. Kind of has a three-wave ABC pullback look to it. Driver 76, wheat. Remember, I've been stalking this one for a while, this double bottom support. It bounced last week nicely, and it was up today. Driver 77, here's the daily. You can see this falling wedge with this MACD divergence. Remember, been talking about it since early last week. Been holding the position here. I still hold it. So this managed to close out of the wedge today. Now we'll see if we can get a little more follow through. Driver 78, here's corn. As I mentioned in the opening comments, corn has kind of an interesting look to me. I think it could be a low risk long. You get a nice MACD divergence down here. You could take a shot, put a stop right at the lows. You could see the RSI divergence as well. Driver 79, URA, uranium ETF. Remember this head and shoulder pattern I discussed on the weekend? Playing out, essentially played out totally. Here's the uptrend line going back to 2020. Getting pretty close to there. You can see it bounced a little bit off this demand zone. You also have the 200-week moving average, but one hell of a haircut from that head and shoulder pattern. Driver 80, here's Bitcoin, which I already discussed. We got down to this first support area, right around this 48,000, 49,000 before bouncing today. Here I readjusted this expanded coil. Remember, the bigger demand zone's down here. Driver 81, here's the daily chart. Driver 82, US dollar, again, down 0.5% today. Off the lows, though. It did get into this little demand zone here before bouncing. You can see the bearish moving average ribbon pinch on the previous bounce. Driver 83, here's the weekly US dollar. Remember, this coil broke down from a few weeks back, continues lower. Moving to precious metals, chart 84, here's gold. Gold was up initially this morning, but in this type of market, things get sold to raise cash and gold pulled back. That said, again, what concerns me about gold is the underperformance of the stocks. So, again, don't get me wrong, guys. Gold's in a bull market, given what's going on in the world and these currencies and the US dollar. And gold is going to do very well longer term, but, I'm thinking it is a little vulnerable in here. Driver 85, here's the ETF, tradable ETF, back into that little demand zone today. Again, it's still overall holding up, though. Driver 86, here's gold on the weekly. Just showing this again because, again, we do have a pretty good MACD and RSI divergence here. The stocks have been underperforming here. So once this confirms a high, I would view this more as a wave 5 of 3. Then you can get a major wave 4 pullback. Again, that won't end the bull market. That'll be a wave 4. Then we should get another, after that's complete, we should get another move up in a 5 to new all-time highs. Kind of like I show here on chart number 87, the monthly. 3, 4, 5. Maybe we get up to $3,000 in the future. Chart number 88, silver, also melting down here, down over 4% today. 200-day moving average below. That could be a low risk area to pick some up. But so far, nice correction. Chart number 89, here's the monthly chart. Like I said, long term, it had a nice breakout earlier this year. Once this correction is done, I do believe it'll restart its uptrend. But it is downtrending for now. Chart number 90, here's GDX, the miners. Again, gap down today, recovered off the lows, still below its 50-day moving average. The concern here is the stocks. Look at the underperformance here in the GDX-GLD ratio. Okay. Driver 91, there's the weekly chart. Talked about this. Remember, we have a potential completed wave 5 up there. So that means this should be now in some sort of deeper ABC correction. Ultimately form a higher low, but we completed that wave 5. And the final chart here, guys, is the BPGDM. Look at this dump. Back down to 75% today. You can see this MACD divergence I've been warning about. That and the previous week, BPGDM got up to 93% or 92%. So was very overbought with negative divergence. Remember, these bullish percent charts only go from 100 to 0%. Up in here was at nosebleed territory, giving a big warning for the miners. Hopefully you guys took some profits. Okay. Again, we had an excellent buy back on March when it was in the oversold territory. Nice to see it unwind a little bit, but I think it's got a lot more to go. All right, guys, that does it. We'll see what happens with this crazy market. Quick check on futures. ES futures are up 44 points this evening. NQ futures are up 231, and gold is up 7. And also Bitcoin is up 1,300. All right. Again, enjoy the rest of your evening, and let's see what craziness transpires this week.